Global markets around the world have entered into a correction. Anywhere you look, from the S&P 500 to the ASX or the NASDAQ, is into correction territory, and markets have continued lower and lower. There are a range of uncertainties abounding, from the macroeconomic space to the inflation and rising interest rates narrative, and of course, geopolitical tensions as well. Investors are now asking themselves, what does this mean for the portfolio? And what should we do in these times of a market correction? Buy, hold, or sell? It's the age-old question, and today we're going to unpack this discussion. And make sure you stay until the end, because we're going to have this discussion surrounding where the markets might head from here, and why longer-term investors often prefer to stay invested, and look at some of the numbers and the data surrounding this. It's a fascinating time with a range of different factors to consider. If you do enjoy the video, don't forget to hit the like button and make sure you've subscribed with your bell notifications on. Let's dive into this discussion that always comes around when the markets start to retrace. And so bringing it right back to the basics, when we experience periods of pullbacks or corrections, we really only do have three clear options. We can either choose to buy and add, we can hold the current positions that we have, or we can sell holdings that we have. I think we often choose to complicate our own scenarios and try to add in a range of different complexities that don't have to be there. But I think it's important for us to distill down these three different options and the different implications that they could have to our portfolios moving forward. So first up, buying. I think first and foremost, many investors are familiar with the fact that sell-offs can often present the best long-term entry positions. Of course, you can buy at different times for different types of strategies, and I think it's worth noting that the discussion that we have today is of course focused at longer term investors. For a shorter term trader or looking to swing trade positions, you're going to have a different mindset and perspective on things. But often sell-offs, retracements, corrections, and dare say it, those market crashes can provide those best opportunities. Obviously, if you see a sector or cohort-led sell-off, not all companies within a sector will act and be equal. If we think about this current technology sell-off that we're in the midst of course, on one side, you've got these mega cap technology names that have got very defensible balance sheets. They're cash generative, huge profit churning machines, and they continue to grow and scale at a rapid rate. These are going to operate very differently to, say, your unprofitable early stage speculative technology names that are not yet profitable. They may have to continue to grow or raise capital to grow. However, all of the technology names have sold off, and so obviously you can see that there may be an opportunity for different companies that may have sold off with a broader sector that actually may have been treated unfairly, thinking with a longer term perspective. It is worth noting as well that sell-offs provide us with valuation resets. We all know we've been in a time with elevated valuations in definitely some sectors or some cohorts within the market. And you can see resets which can provide more interesting or compelling entry propositions as a result of that. It is worth noting, I guess, as a bit of a first principle to assess whether it's a fundamental or a sentiment-driven move. Sentiment-driven moves is where there's interesting opportunities. Fundamentally driven moves obviously speak to some issues, potentially with our investing thesis, or at the core operations of the business. And this is worth noting and being able to distill down these differences. But you also do need, on the other side of the coin, a strategy for capital management. You don't want to be that person who continues to buy a falling knife. You continue to dollar cost average in, but you run out of capital or spare powder as the move continues to go lower and lower. Everybody's going to approach this differently. Some will look to dollar cost average in at different points or looking at different support levels. Some will wait for a bottoming out indication on the trends, while others will just look to buy in different increments at different periods of time. Everybody's going to be different. Developing your own strategy is what works best for you, your temperament, your amount of capital that you have, and your interpretations of where the markets might head from there. But I think what's most important is that research underpins confidence. You don't want to be guessing. You don't want to be throwing your hands up in the air. You want to be having a strategy that you've developed prior to these periods of fluctuations and uncertainty that you can then act on with a logic-driven strategy as these periods come up. Keen to know your thoughts on it all as well, so drop in a comment below what you think about this current period of uncertainty, how you're looking to take action on it, or what your thoughts are surrounding it all. And before we dive in, standard disclaimer, as you guys know, I'm just a bloke on the internet who loves talking about the market. Nothing we discuss is financial advice, it's all just a generous discussion to be a starting spot for you to go away and do your own research from. Option number 2, it's holding. Holding in itself is a decision, even though it can often seem like a non-decision at times. There's a few key factors to consider. I know that most of us are familiar with them, but it is worth reminding. Sell-offs and correction periods will eventually pass. At the end of this video, we'll explore some of this notion in detail, but just keep that at the top of the mind. Fluctuations, of course, are a normal part of functioning markets. Markets don't move up in a straight linear line, and they definitely don't move down in straight linear lines as well. They move up, they move down. There are bull traps or bear traps. There's retracements, there's counter trend rallies. They move in different types of movements, and so retracements are just a normal part of a functioning market. It's what you want to see, and hopefully in an upwards trend, you see higher lows, but you still see those retracements along the way. We know that we can't avoid volatility, so probably the most pragmatic move is to look for the opportunity rather than looking for the fear. Of course, that's easier said than done, and everybody's going to have emotional reactions to the market. It's a natural part of being a human and approaching the market there. But try to look for the opportunity rather than giving in to the fear that will come up. And I think it's worth noting that often short-term movements are often just noise and sentiment. Underpinning this factor is the fact we're investing into companies. We all know this. I'm sure you're like, yes, that's intuitive, that makes sense. But too often people get sucked into investing into 3-letter ticker codes or 4-letter ticker codes. And they're like, oh, it's up today. There's green on the market. There's red on my screen. Something must be going wrong if the stock's going down, or things must be going up if the stock's going up. That's not the reality. Company building takes time. For anyone who's built their own business or even just side hustle or company, they will know, and even if you've been involved in developing a startup or you work for a company, you will know how long these things take to build, and also that it is a process. Imagine if we tried to sell our house every time the housing market was down by 5%, or we looked to add and buy a new house every time the housing market was up 2% on a rally. It just doesn't make sense. These things take time, company building takes time, and so we should approach these as long-term investments, not ticker codes or dollars on the screen. And then, of course, the third option, which is a viable option, is selling. I think first and foremost, before you're selling, you want to make sure that you're constantly checking against your initial strategy and plan. You should have a plan, whether it's written down in your mind or at least something you've thought about before taking positions. You don't want to be just investing on a hunch or a tip or something that someone's told you. You want to be researching and developing conviction in companies before investing for the longer term. So revisit your investing thesis. See if anything's been invalidated or changed, or maybe it's just a fluctuation that's happening as part of the market. And I think what's most important is you want to make logical and not emotion-based decisions. It's not easy, but if you can revisit this plan, rethink about how you really were considering things could play out when you took these decisions and initial positions, then you can really hopefully make your decisions moving forward based on logic. Whatever your decision is, maybe a logical-based decision that's best for you is selling. Maybe it's adding and buying, maybe it's just holding, but make this logical-based decision. It is worth noting, however, that there are a couple of inherent risks with selling if you're a longer-term investor. Of course, this doesn't apply if you're looking to short-term trade or you have other ways that you want to engage with the market. Firstly, if you're looking at selling in the short term and adding back later on, will you be able to get your units back? There are tax implications, and so of course you need to think about, will you be able to get the same amount of units back? And also, how will your mental bandwidth go? This will depend on each individual's temperament, but it's not as easy as just selling and saying I'm going to buy when it gets lower and add the same amount. You obviously have to be paying attention to the market. It's a lot more difficult to continue to watch the market. Maybe over the weekends, you'll be worried about, will there be a piece of news? Will there be an uplift? What's going on? Longer term investing is the most easy, hands-off, passive form of investing because you don't have to be watching on the day-to-day and watching those fluctuations. But I do think it's worth noting as well that if you miss the best days on market, there is a compounding effect that can be missed out on. And so this is the compounding effect. This is an interesting time frame. It's an interesting time horizon. You can see here that the data and the research here has used a time period from late 2005 to the back end of 2020. And what they've used here is just an imaginary $10,000 mark, but you can extrapolate out as a $100,000, $1 million, or $1,000, whatever suits your portfolio size. But they've used a $10,000 mark from early 2005, and it's worth noting that this includes the period of the GFC and the period of the virus and the lockdowns in 2020. So 2 crashes of 30% or more. And so if you had have just invested that $10,000 in 2005, closed your eyes, invested into this, and allowed the market to do its thing and continue to fluctuate, continue to move, and continue to trend, at the back end of 2020, this $10,000 would have been worth $41,100. Or if you had $100,000, that would have been worth $410,000. And so what this is really saying is that even though there are fluctuations, there are crashes, there are of course fears, there's uncertainties, there are many different corrections throughout these periods. If you just buy and hold, you expose yourself to the opportunity to continue to compound. And as Warren Buffett puts it, to bet on America or to bet on Australia or to bet on the nation that you're investing or the asset that you're investing into over long periods of time. And I guess just to really amplify or build on that point, as we've talked about before, if you stayed fully invested, you would have had an annualized total return of around about 10%, 9.88%. That $10,000 would have been worth $41,000. However, if you just missed only the 10 best days on market, that $41,000 would have come down to $18,000, and you would have only got a 4% annualized return. Now, if you miss just the 20 best days of over around a 15-year period, so just the 20 best days, if you were trying to chop and change, take positions, that return would have come down to $11,000, and you only had $10,000 invested. Now, if you missed only the 30 best days, suddenly you're not actually making a gain anymore, but you're making a loss of 1.88% on average. And you might be like, oh, of course, but how would you miss those gains? You can tell when markets are turning. You can tell what's happening on the markets. We've had just a really clear example of this on the Friday session on the S&P 500 and the NASDAQ. The NASDAQ was up by 3% on the back of Apple's earnings. It was one of the best days that we've had on markets since June 2020. There was really no indication of that. There was a lot of uncertainty and fear about the correction. But if you missed one of those days, that would have counted as one of your best 10 days. Now, over a 15-year period, you can see the compounding effect that could have for your gains. Now, it is worth noting that these are historical returns. Past performance is no indication of future performance. Things can change. Nobody knows what's going to happen and play out on the market in this upcoming period. But this is just a bit of an indication and a bit of performance that you can benchmark future returns for. And so it is just worth noting this, as all data, all insights, they are worth noting, and they're worth having a bit of a think about how we could potentially use them to inform our strategies or our decisions moving forward. And so having a look here, just to really build on that point there, I know we've talked about it, but there really is always reasons to sell. This is a really fascinating chart that's come up and just provided some insights at the back end of 2009, out of the GFC, all of the different fluctuations, negative news events, uncertainties that could have been considered reasons to sell at one point or another. From all the way through, each of these in their own rights would have been an uncertain period. But if you have a look at it here, we can see that, of course, the market has continued trending higher over this past period. Of course, there's different insights about that. There's the monetary policy discussion. There's questions about central bank's performance and everything that's played out over this past period. And every investor, every analyst, every economist is going to have different interpretations about that. But as you can see, that over long periods of time, there's always going to be uncertainties. There will always be corrections. However, the market has continued to trend higher. And the best way to potentially get exposure to that is to be a long-term investor if your focus is long-term investing. And so the question is, what happens from here? I think first and foremost, it's really important to get it out of the way. Nobody knows. Not the best economist, not the best investor, not the best analyst. The markets are always just a balance of probabilities. We all come up with our own probabilities based on our worldview, our research, our understanding, and the assumptions that we have about the future progress of the markets. But nobody knows. All we can do is make our own best assessment of it. I think it's important to develop our strategies before we need them. You don't want to be making your strategies in the heat of battle, in the midst of a correction or a sell-off while emotions are high. Focus on these logic-based decisions, but also remember that often drawdowns can present the best opportunities. This isn't to say it's the best time to buy now. This isn't to say this might not be the start of a broader correction, bear market, or even a crash. Who knows what is going to happen? Nobody does. But I think it's always worth noting, underpinning this all, when in doubt, zoom out. Over long periods of time, it can be a reminder that when we look at the chart on the right, yes, it's a correction. Yes, it can be scary and uncertain as we're in the midst of it. But if you look at where we are and how far we've come, it is a bit of a reminder that if you want to be a longer term investor, it makes a lot of sense to focus on long-term trends. Hope you enjoyed the video. If you did, don't forget to hit the like button. Feel free to share it out. We make daily videos, so if you haven't yet, make sure you've subscribed and turn your bell notifications on. Thank you so much for joining us. Keen to know your thoughts on it all and how you're playing this market. For now, stay well and happy investing.